So future projections of interest rates, impacts to the real estate industry, and then insights into next year. Delivered from my Chief Capital Markets Officer at Guaranteed Rate Companies. Looking at even odds for Fed cutting the rate next month, looking for approximately 50 to 75 point rate cut. This is happening because Bitcoin and stocks are continuing to rally. Be on the lookout that even though rates are going to be continuously dropping, they're going to be dropping at a lower and slower rate. So what that means for some of us is that there will be no refi boom anywhere on the horizon just because rates are not that much lower and people aren't going to be saving that much money in a refinance. But unfortunately, because this is just the worst affordability in decades in terms of housing, counting on interest rates to drop is not really going to make home buying more affordable, unfortunately. One thing I thought was really interesting that he noted was talking about use of federal lands for new construction, the impact on that, and also talking about how builders are actually building bigger homes that don't necessarily market to first-time home buyers because the builder's bottom line in terms of building homes less than 1,400 square feet, which is like kind of the sweet spot for first-time home buyers, it hurts their bottom line and they're not actually able to make any money on building these houses. Ergo, creating a lack of inventory for people who are first-time home buyers. I thought what was really interesting that he shared with me too is a little bit about the differences in the presidency and what to expect in our upcoming presidency. So currently, the Biden administration and previously has Freddie Mac and Fannie Mae. They are regulated and they're held within the government, and this keeps affordability to the consumer. Trump wants to move Fannie and Freddie into the public sector, so they'd be publicly traded companies, they'd be held to their profits and their dividends, etc. This would limit exposure to other non-main funders, so retail lenders, fewer big banks in terms of the funding. Retail lenders would then have to sell mortgage-backed securities, so that convolutes a different process. And that would limit, supposedly, not 100% I understand this, limit concentration on non-owner occupied loans so that it doesn't put taxpayers on the hook for people's investment properties. Like it puts the tax onus on the investor. I think that's how I understand that. A lot of information in there and a lot of like, we'll see what happens. But just expect the interest rates to continue to go down. They see them going down below 4%. That's the Fed rate in September of next year. So we got projections all the way through September, and we're looking to see that. So low and slow. If you have any questions, let me know.